Yeah, well, the most important thing coming up this week is Jackson Hole. Of course, every year, Janet Yellen, whoever's in charge of the Fed, takes the opportunity often to lay out a pretty key message about how they see the economy. And this year, the whole theme of Jackson Hole is labour markets. And our view is actually the Fed's far too complacent about labour markets. Unemployment's been falling sharply, wage inflation in the States has started to tick up. And there's this view at the Fed that there's lots of slack in the labour market. Well, we've been crunching the numbers, and our analysis is coming out this week, and it seems to us, even on a benign view of the labour market, unemployment rate should hit 4% in 2016. 4% is totally full employment. It just doesn't go any lower. So, wage inflation's heading up, cheap money needs to go, and of course it's cheap money that's sustained high asset prices over the course of recent years. So this is a pretty dangerous cocktail. So at some stage over the next 4 months, when the Fed eventually decides to start playing catch up, asset prices are going to struggle. Now in the best case scenario, we'll see sort of 6 to 9 months sideways down a bit in asset prices, and a digestion of the market seeing that adjustment playing out, a bit like we saw with the taper tantrum in May 2013. The market has to adjust and so on and digest that. Worst case scenario, we'll see quite meaningful moves to the downside. Of course, if you look at the S&P 500, because of this cheap money, we haven't had a 10% plus move really since 2012, which is an awful long period of time. So, I think the asset prices will struggle. They'll be the biggest losers, particularly equities. And yeah, there should be some quite serious return of volatility with a change in stance from the Fed as and when it comes. But as I say, Jackson Hole this week, signals from Yellen will be totally key. Yeah, well, I think, a change in rate profile from the US and rate expectations is going to favor the dollar. So, I think net you'll see flows going back to that, away from emerging markets, which have been real beneficiaries over the last decade or so of zero easy money. We know the story, and that's already starting to unwind in various parts of the emerging market world, but also places like Australia. The Australian dollar, I think, is going to come under meaningful pressure with its different interest rate differential. So I would look for money to go back to the US, and indeed to the UK and Europe as well, where the UK in particular will have the same change in rate profile and follow the US rates, and Europe will eventually. So, for us, it's the last sort of third of the economic cycle. This favors Western equities, UK, US, and Europe in particular. Yeah, well, Aussie equities clearly, they're not going to buck the trend of where the US goes. But it's just, once you translate for the exchange rate, it's a loser in the global equity environment. So, our view is people should be underweight. Domestic Australian investors should be meaningfully underweight domestic Australian equities and overweight international.